So the topic we are starting today is called cost of capital. How I want you to think of this topic is, imagine a typical corporate finance team of a large organization. This team, the corporate finance division, would be divided into roughly the three parts. The first part would be the sourcing team, and second part investing team, and third part would be the treasury team. The job of this investing team is to calculate numbers like NPV, calculate numbers like IRR, payback period, discounted payback period, profitability index, and comment that whether the new business proposals that have come up, are those financially feasible, are those good ideas. Once these people decide that, okay, fine, maybe setting up a new manufacturing plant seems like a good idea, then the job of sourcing team is to get them those finances in the best possible fashion. Which means if the requirement, let's say, is of $200 million, then it is a sourcing team which will try to get the right mix of debt, right mix of equity and preferred stock in such a way that cost of this entire capital is lowest. And once the project starts, then the job of the treasury team is to ensure that working capital is being managed effectively, the cash is being well taken care of. So we have already seen how to take care of the investing part. We've learned to calculate these numbers. Today's topic is focused on how to raise money from the market in the best possible manner in such a way that your total cost towards that capital is lowest. Are we fine here? So I would be spending first 20-25 minutes on doing basics. Most of you would already be knowing it, but we'll still go through them carefully, and then we will start with what is given in the CFA Level I syllabus. So now, if you want to raise capital in a business, that means if you want to put in money, tell me, what are the sources through which you can get that money? You can get that in the form of, first, equity. What is the meaning of equity capital? The amount of money which is invested by owners. Then you can also get money in the form of loan. So in this reading, we would be referring to loan as simply the debt funding. Let's say you go to a bank, you pay them interest and you get the debt funding. There also exists a hybrid instrument which is between the two, which is called as preferred stock. So these are the three possible sources through which you can raise money in the market. First, we will understand the difference between equity capital and debt, and then we will spend time on understanding what is preferred stock. Okay, so let's now discuss this part. You can write down with me. Equity versus debt. Let us say you're an investor and there is one particular company where you want to put in your money, and there are two choices. Either you can buy the equity shares of that company, or you can buy bonds of that company. So when you're buying bonds, you're essentially buying the debt instrument. If you buy equity shares, through what sources do you expect to earn? We are expecting to earn in the form of dividends. And dividends are nothing but the amount of profit which is shared by company with you in cash. Is this the only source of earning money through in equity? And we will also have capital gains or capital appreciation. Right? So you buy few shares, let's say at a price of 100, they become 120, that's your earnings. When you invest into debt, what are the sources through which you're going to earn? In most of the cases, the only source in which you would be earning money is the interest income. Now, is the rate of interest fixed in advance? Generally, yes. If it's a fixed rate loan, then we know, so this rate is fixed in advance or known in advance in most of the cases. But is the rate of dividend fixed in advance? No, it is a function of how much profit company makes in that particular year, which means this earning could be variable. Now imagine a scenario, a particular year, when a company has actually made losses. Will it be compulsory for them to still pay interest? Yes. So interest is paid irrespective of level of profit. Interest is paid irrespective of level of profits. But how about dividend? If a company has made losses, can they pay dividend? Generally no, because dividends are sharing profits in cash, and therefore dividends are paid only if company is making profits. Now let us say you are a risk averse investor. What does it mean? You like risk? Dislike risk. Risk averse means the one who are trying to avoid the risk averse. So if you are a risk averse investor, what investment would you prefer? You would prefer debt, because every year you will receive interest, you would receive your original investment back at the maturity. But if you are a risk loving investor, or if you are a less risk averse investor, then preference for you would be equity. So let us introduce the third instrument in this scenario, which is the preferred stock. Now, in preferred stock, how do you earn? Do you earn in the form of interest, or do you earn in the form of dividend? You earn in the form of interest. Dividend or interest? How many of you feel dividend? How many of you feel interest? Okay, fine, then dividend. So there are preferred dividends, and is this rate fixed or is this rate variable? Fixed. And that is why it is in a way some sort of a hybrid between equity and debt, because equity dividend is always variable, interest is fixed. In preferred stock we still get the dividend, but it is a fixed rate of dividend. Now this dividend, is it compulsory to be paid every year, or is it paid only if the company has made profits? Compulsory, right? Irrespective of level of profitability, we have to pay preference dividend. Agree? How many of you agree with me? Okay. Preference dividend is paid only and only if company has made sufficient profits. If company has not made sufficient profits, then they are not obliged to pay preference dividend in that particular year. Okay, so write down the point here. Preference dividend or preferred dividends are paid only if company has made sufficient profit. Preference dividend is paid only if company has made sufficient profits. Are we fine here? Now imagine a scenario. This example that I'm doing now, I want you to write down in some corner of your notes. Let us say company has made profit before tax of 500. The current obligation is that they have to pay interest of 300. They have to pay preferred dividend of 150. They have to pay equity dividend of, let us say, 200. clearly we can see that they are short of money. They do not have sufficient money to take care of all of them. We are going to assume that taxes are 0 for this example. The priority or sequence in which the amount is to be paid, we will pay entire 500 to interest. Debt is always given the first priority when you are repaying the or when you are paying the interest. Then second priority is given to preference dividend. This is the reason why they are called preferred, because you get a preference over equity shareholder. Are we on agreement here? So 150 would be paid to preferred dividend, and then whatever is left, that would be paid to the equity shareholders. Is that fine? So second preference is of preferred dividend, and then the last one is of equity. Same fashion, let us say that company is liquidating. What does it mean? They're shutting down the business, they're selling off all the assets. After selling off all the assets, the company has received cash of, let us say, 5,000. Now, out of this 5,000, the investment of debt, that means debt are claiming, let us say, 3,000. Preferred stock are claiming 3,000, and equity are claiming 10,000. The sequence in which payment would be made, entire debt would be paid off first, and then 2,000 would be paid off to preference shareholders, and nothing would be paid to the equity shareholder. So preference shareholders get preference at two places. Number one, in case of payment of dividends, and number two, in case of payment of the liquidation amounts when the company shuts down. Are we fine here? So write this down quickly. There is one particular term that I want you to write down. I haven't seen this term in the CFA syllabus. However, it is a most popular question. In fact, yesterday one of our students in one of the equity research interview was asked this question. So when you pay interest, this interest is called, I'm going to just write it here, that interest is called as charge against profit. Charge against profit. And the simple interpretation of this is that when it is said charge against profit, it is tax deductible. Right? So we've already seen this, that when you pay interest, it reduces your profit, and because your profit reduces, you have to pay lesser amount of taxes. So when you pay interest, it is called as charge against profit. When you pay preference dividend, this is called as, tell me, appropriation of profit. Appropriation of profits. And meaning of this is that this is paid after taxes, and therefore it is not tax deductible. Not tax deductible. And again, equity dividend is called as appropriation of profit. We don't? No. In India, we have a tax on dividend. That's a different tax. It is not income tax deductible. Any questions you want to ask here? Okay. Now, we would spend about 5-10 minutes and understand how is this preferred stock, where is this preferred stock put to use in real world scenario. Should I clear up the screen? So I'm sure you might have heard or come across this word, private equity. Have you? What is this? What is private equity? Yes, these are the fund houses, or these are the funds which invest into very early stage companies, or rather companies which are not listed, right? So not necessarily always early stage companies. Now maybe Flipkart today, it's not an early stage company anymore, right? But there are different size of funds which invest into different type of companies. So roughly you can categorize them as angels, VCs and buyouts. Angel means they would invest only into your idea. So today morning I was reading about some Hola Chef company in Mumbai. These guys are kind of a food marketplace, okay, where if you're a chef and if you feel you want to sell your food online, then you can register on their website, and then people can see what you're serving, and then they can buy from you. Okay, so these people have received about 20 CR rupees. So when an early stage company, when an investor invests into your business only based on an idea, then typically those category of investments are called angels. Then VCs are slightly later stage. VCs would typically invest into biotech, technology based startups. Today the distance between angels and VC is kind of disappearing. So they're more or less in the same segment. And then the buyout funds, which would typically invest into large size companies. Okay, so maybe those kind of funds which have been investing into Flipkart or Snapdeal, then those funds are called as buyout funds. Now what these investors would typically do is, they would pick up a small company today, let's say this is time 0, and they would expect that in next 5, 6, 7 years, so in India the life cycle is roughly about 5 to 7 years. So about in 7 years time, the company would be substantially larger in size, and therefore this is a time when I would like to exit. So let's say this is 7 years. If you've done X amount of investment at time 0, then you would want to invest or exit, let's say at a price of 10x, 15x. If you're lucky, in cases there are also 150x, 200x, 300x type of exits. So you invest into a startup, you help them grow, and then the company grows to a substantial size, and then either exit route could be in the form of IPO, or exit route could be in the form of second sale, selling to some other private equity house, and then you try to earn substantial profit on this. Are we together on this? Now imagine a scenario that you invested, let us say, 5 million into a small startup today. Your idea is that in 7 years it would be a large company, and then you would sell your shares maybe at 50 million or more than that. But the question is, if I invest 5 million in equity shares today, and if I exit here, in those 7 years you would get to earn nothing. Are you following me? There would not be any tangible earning that's coming your way in those 7 years time. So rather than giving shares in the form of equity, what these investors prefer is, they would give out shares in the form of preference shares. So every year you would get to earn some dividend, but these preference shares would be convertible preference shares. So for 7 years you earn dividend, let's say at the rate of 15% per annum. By the end of 7 years, you convert your equity shares into, you convert your preference shares into equity shares and then become owner of the company. Now, seems like a really good strategy because you're getting best of both. You're getting regular income for the 7 years and then you're getting equity. But imagine now how these people think. They think that what if the way I projected, company didn't behave this way, because I'm just clearing it off. What if the company behaved in this fashion, that first 2-3 years they made losses, but later on they picked up. If this is the case, the years in which the company was making losses, I will not get any dividend, because preference dividend is paid only if the company is making profits. So what I would do is that these convertible preference shares would also be cumulative. Meaning of cumulative is that, let's say your dividend was X amount here X amount here, X amount here. The year in which company makes profit, they will have to pay you 4x. Dividend of previous 3 years plus dividend of this year. That means your dividend does not lapse, it gets accumulated. Is that fine? And then what if the company doesn't even go with this route? What if my estimates were completely wrong and the company just starts picking up right from year 1 and it becomes substantially larger than what we originally estimated? If this is the case, in these years we would get to earn only the preference dividend, but we want to earn more because we are the ones who are putting in money. So if the company is making more profits, I also want those extra profits, and therefore these shares would also be participating. So CCPPs are the most popular investments or instruments which are used in these kind of setups, angels or VC type of funding. Are we fine here? Should we go ahead now?
But can it be a combination of cumulative and convertible both, and
Yes.
convertible and not participating?
Yes, it can be. It can be a combination of anything. The question he asked, can it be a combination of cumulative and convertible both? Okay, so see, these days you can, if you think of a new idea, you can create a custom instrument yourself. Right? So you sit with the investor, you negotiate how it is going to work, and then you can create whatever type of investment you like.